sign on. We have a number of people that have already signed on, but if you can give us maybe about 2 or 3 minutes so that we get most of the people signed on, we'd appreciate it. So we'll be back with you in about 2 or 3 minutes. Thank you. Hi, thank you for joining us. My name is John Roberts, and I'm the Managing Director of Axiom Valuation. I will be the moderator for this webinar. We would like to welcome all of you to the webinar entitled Valuation, Risk Management, and Marketing Requirements of the European AIFMD. Is your firm prepared? There will be 3 15-minute presentations from experts in the area of valuation, risk management, and market requirements, and a question and answer session at the end. Please enter your questions under the question tab on the menu on the right of your screen, and we'll get to each of them at the end of the webinar. If we do not get to your question during the allotted time for the webinar, we will respond to you individually by email after the conclusion of the webinar. We will be recording this webinar, and we'll send a copy of the recording to all of the attendees along with the slide deck. Here is the obligatory disclaimer slide, and I'll let you read that at your leisure. And we'd like to start with the Alternative Investment Fund Managers Directive, AIFMD, goes into effect on July 22nd, 2013. This is the most important directive to date coming out of the EU for alternative investment fund managers and has a number of implications for the way that AI managers do business. In this webinar, we would like to cover 3 specific areas where the AIFMD will affect an AI manager's business. The first topic will be valuation of illiquid assets, presented by Stan Feldman. Dr. Feldman is a recognized expert in valuation and has published many articles and books on the subject. He is the CEO and founder of Axiom Valuation Solutions and is an associate as an associate professor of finance for over 20 years has published extensively in the area of valuation. You may read a detailed description of his background on the Axiom website. And And now I would like to turn the presentation over to Dr. Feldman.
Thank you, John. My presentation today is entitled Valuation of Illiquid Assets, Valuation Standards and Methods Consistent with the AIFMD. Topics we will address in this part of the webinar are: what is the AIFMD valuation mandate and its resource implications? Is fair value the appropriate valuation standard under AIFMD? What are the appropriate valuation methods to use when valuing complicated illiquid assets? What are the implied AIFMD guidelines to fair valuing illiquid securities? For example, a junior RMBS tranche, preferred stock, or a corporate loan, syndicated or leveraged loan, if you will, which I cover in the appendix. And finally, what are the takeaways for attendees? The AIFMD valuation mandate is clear, as the above excerpt from the directive indicates. Independence, functional separation effectively requires some level of additional resourcing by the AIFM. The AIFMD does not require outsourcing of the valuation function, but it does require that prices assigned by the manager meet the positive assurance standard. Now, this means that the prices assigned are consistent with what an objective, informed third party would conclude. In short, assigned prices vetted by a third party effectively mean that the AIFM has established a framework which meets the independence criterion. The AIFMD has multiple goals. Among these are transparency, assessment of systemic risk at any point in time. Transparency is directly related to valuation of assets and particularly financial securities that are highly illiquid. Systemic risk measurement is related to the aggregation of risk profiles of AIFs, which, as Thomas will show, is related to valuation requirements. Independence requires an objective third party to opine as to value. This means that the factors that need to be considered to form such an opinion by definition must be explicit and clearly defined, i.e. transparent. Fair value is the only valuation standard that is consistent with the requirements of AIFMD. Consistent with financial reporting standard IFRS 13, which is the fair value standard, the characteristics of fair value are: it must be an exchange price and exit price. Transaction takes place in primary market under certain conditions, most advantageous market under certain kinds of conditions. Transaction takes place under normal market conditions. And a hypothetical transaction price of an illiquid asset based on verifiable market inputs used by an informed market participant. While GAAP and IFRS define fair value in essentially the same way, there are important differences that center on the valuation of alternative assets. From the AIFMD, the most important differences relate to an assessment of level 3 assets, which require the fair value to be established based on sensitivity testing. This, of course, fits nicely with the directive's requirement measuring value at risk, or VAR, which is a well-known metric for measuring the percentage of an investment that may be lost. Thomas will have more to say about this in a few minutes. But at this point, it should be clear that fair valuing a non-traded security and at the same time measuring the portion of the value that's at risk does require a substantive modeling framework to incorporate all of the valuation factors that need to be considered. Put differently, there are 3 drivers of value: expected after-tax cash flow, which is net operating profits less CapEx, less change in working capital; cost of capital, and liquidity adjustment. Stress testing of fair value conclusion means that there needs to be a formalized model structure that quantitatively links changes in model drivers to changes in fair value assessments. Hence, the fair value standard indicates what factors to look at, while valuation structures indicate how these variables are to be used to reach a fair value conclusion. Finally, by stressing these input factors simultaneously, one can ascertain the fair value distribution, which is a primary focus of risk management. The fair value hierarchy incorporates two basic methods, market comps and the income method, which includes DCF and more broadly option models. These models require market inputs, and we know they are used by market participants to form opinions of value which underlie transaction prices. In cases where assets are not frequently traded and or are traded in thin markets, trading volume to outstanding is low, as in the case with common equity of small firms, some adjustment or discount to the model price needs to be made to arrive at fair value. A put option model has been found to be useful in measuring the price of liquidity. Several publicly traded hedge funds use this method as an input to fair value assessment of the fund's underlying assets. The put option measures the price a market participant would pay to ensure that at some point in the future the security can be sold at today's fair value. Market inputs are volatility, which is observable, risk-free rate, also observable, and time to expiration. As time to expiration becomes shorter, the value of the insurance, illiquidity, is reduced. Since the time it takes to transact the security is less, the greater the number of security holders, it follows that a key parameter of the put is a function of the number of owners of the security. Hence, because the parameters of the put are measurable, they also can be stress tested, and then its impact on transaction prices can be quantified. In similar fashion, one can measure the degree of the liquidity associated with a syndicated or leveraged loan, since syndications include many managers familiar with the characteristics of the security. The asset classes shown are representative of the types of assets that AIFMs invest in. In cases where the assets shown are not priced in a continuous market, level 2 and level 3, the use of data feeds that provide indicative pricing has limited value. The reason is that these prices may not reflect exits, and more importantly, there is no way to incorporate a price point into a sensitivity and risk assessment framework, which is a requirement of the AIFMD. In the credit space, fair value assessment, as well as default probability estimates, are embedded in the credit spread yield curve, which for the most part is based upon observable data. Credit ratings are often not current. As part of a fair value assessment, the security needs to be re-rated. The leveraged loan example shown in the appendix shows Axiom's credit rating platform, which allows Axiom analysts to re-rate a security and then use the appropriate market observable credit rate yield curve to calculate the required rate of return. Given contractual cash flows, calculating the fair value price is straightforward. The framework is then easily used to stress test the fair value price, as well as to undertake more robust testing associated with risk management implications of the directive. Now let me address two examples of applying some of the principles touched on to establish the fair value of two types of the liquid securities, junior RMBS tranche and preferred stock. Time does not permit me to address the valuation of leveraged loans, but the appendix, as I said before, to my presentation shows an example of what is needed to fair value a leveraged loan. The key to this is having a formalized model that incorporates the assessment of the underlying credit and the potential for default. Please contact Axiom Europe for more details on Axiom's credit and fair value pricing platform. The security in question trades infrequently. The pricing framework uses market inputs, LIBOR yield curve, credit spread yield curve to establish fair value. The structure also allows one to carry out sensitivity analysis and risk assessment in a straightforward way. Although not shown, it can address the pricing that would hypothetically emerge if a credit event occurred. There are no reliable comparables to use to fair value the target security. This means that a hypothetical market participant cannot rely on pricing information of comparables as a guideline to pricing the tranche. First, under the assumption that the credit rating at issuance is reliable and remains so between the issue date and the measurement date, then there is a relationship between the credit spread at issuance and the credit spread for an A-rated finance credits at both the measurement date, at the issuance date and the measurement date. This ratio in this example is 0.75 as shown. If this ratio remains stable, then pricing the tranche is straightforward as shown above. In pricing junior tranches of this type, the greatest uncertainty centers around the probability of default, which shows up in the credit rating. Hence, if the rating is stale, fair value guidelines indicate that the rating needs to reflect default expectations at the measurement date. There are several ways to address this issue, which center on Monte Carlo analysis. Unfortunately, we do not have time to address these procedures here, but suffice it to say the pricing of the tranche needs to reflect its payment history and the risk that payments will either not be made on time or not made at all. In this example, a private equity firm invests in a convertible Series C, which is convertible preferred, and needs to value the position 1 year later. In order to do this, one needs to first value the enterprise and then subtract the value of debt and other claims to arrive at the value of equity. The contingent claims model, an option-based framework, is then used to allocate the equity value to each capital component. Each component is then adjusted for lack of liquidity to arrive at the respective fair values. The central drivers to pricing the components of the capital structure are calculated enterprise value, resulting equity value, equity volatility, and liquidity event horizon, the time when the firm will have a major liquidity event, either an acquisition or an IPO. In general, the use of market prices of traded preferred shares cannot be used in this case unless, of course, the capital structure of the firm issuing the traded preferred shares has a capital structure similar to the target and the preferences of the capital components are sufficiently similar. Axiom's experience indicates this is highly unlikely. The example shown indicates that the value percentage is generally greater than the ownership percentage for preferred stock and is the reverse for common stock. The reason for this is related to preferred stock liquidation preferences and control characteristics of preferred stock. Axiom's 409A primer provides detail on the valuation of a firm's capital structure and is available on Amazon for a modest fee. What are the takeaways for attendees? 1. The central feature of AIFMD is that it imposes functional separation, that is independence, between investment management and post-investment valuation of fund assets. This implies that prices assigned to assets must be vetted by an objective third party and the standard used must be fully transparent. The only standard that meets the objectives described in 1 and is the accepted financial reporting standard is IFRS 13, the fair value standard. The underlying assets of AIFs are often highly illiquid, level 2 and level 3. For these assets, the fair value standard requires the use of market inputs along with accepted model structures to arrive at a conclusion of value. IFRS 13 is fully consistent with the AIFM directive in that it requires sensitivity testing as a critical input to establishing the fair value of illiquid assets. 4. Given the directive's requirements, AIFMs must formalize the valuation frameworks and be prepared to use these frameworks to establish fair value and use them in sensitivity testing and as a critical component of risk management analytics. Thank you.
Thank you, Stan. And this next slide here is just a little bit about Axiom valuation. We have a similar slide for each one of the firms presenting. And the next topic is entitled Risk Management, Implementing Robust Methods for Back Testing, Stress Testing, and Scenario Analysis, and will be presented by Dr. Thomas Klepsch. Dr. Klepsch specializes in developing innovative products and services for the financial industry. He is currently the Vice Chairman of the European Bond Commission and a Senior Consultant to Axiom Valuation Solutions Europe. You can read more about his background on the Axiom Valuation Solutions Europe website. And now I would like to present to you Dr. Klepsch.
Thank you very much, Sean. What I'd like to do is to jump directly into the topic of risk measurement. In this section of our webinar, we are going to address the risk management requirements as laid out in the Alternative Investment Management Directive. In Article 15 of this directive, we find the essentials of the regulatory requirements. This raises the following questions, which will be answered during our webinar. Firstly, and most obviously, what are those requirements as laid out in Article 15 of the directive? Secondly, what are the challenges for portfolios containing illiquid, or better, not frequently traded securities? Thirdly, what choices are available for alternative asset managers in the risk measurement space? Fourthly, how Axiom Valuation Solutions tackles the issue of risk measurement for non-marketable securities. And finally, what are the basic considerations for risk measurement in the alternative asset space? Let us start with the Alternative Investment Fund Directive. In Article 15, the directive calls once more for independency, this time for an independent risk management function, and it demands the implementation of an appropriate risk measurement system. It reads, the alternative investment fund manager shall functionally and hierarchically separate the function of risk management from the operating units, including from the functions of portfolio management. Then the directive gets more specific. The alternative investment fund manager shall implement adequate risk management systems in order to identify, measure, manage, and monitor appropriately all risks relevant to each alternative investment strategy and to which each alternative investment fund is or may be exposed. This demands the continuously assessment of the risk embedded in each investment position and its relation to the entire portfolio. Later on, the article calls specifically for the usage of stress tests. For those asset managers that are using leverage within their portfolio, the directive demands a thoughtful documentation and limitation of the resulting counterparty risk, a clear statement regarding the rehypothecation of collateral, as well as an overall commitment to limit the leverage to a predefined threshold. It reads, the alternative investment fund manager shall set a maximum level of leverage, which they may employ on behalf of each alternative investment fund they managed, as well as the extent of the right to reuse collateral or guarantee that could be granted under the leveraging arrangement. How to apply all those requirements in a world where market prices are rarely available. As the focus of this webinar is set on alternative asset managers that are dealing primarily in not publicly traded securities like private equity and whole loans, the question emerges how to fulfill those quantitative requirements set by the European Commission. How to measure the risk resulting from investments for which the traditional value-at-risk approaches, looking at historical changes in market price, will not work. How to adopt the value-at-risk philosophy to a space in which market prices are largely absent by investment design. How to formulate appropriate stress tests for those assets. Next slide. No, John, this is one too far. Please go back 2 slides. No, one more in advance. As far as I can see, there are 2 potential solutions to the risk measurement problem. Firstly, we can tweak value-at-risk systems to deal with non-frequently traded securities. This is normally done through factorization. It just makes the fair value of the private assets dependent on some market factors which can be frequently measured. John, we are still on the wrong slide. Which can be frequently measured. This is simply a translation of the risk, or maybe noise, embedded in certain market factors into an essentially and intentionally not marketable asset class. This translation may not capture the true message, as it is truly secondary to the fair value determination of the alternative asset class. This leads us, secondly, directly to the valuation process itself, through which not only the fair value of those investment holdings is defined, but also a range of potential values is produced as input in the calibration process. Those inputs, and this is our main thesis, contain the risk information the European Commission is demanding. In other words, the inputs in the valuation process itself contain the risk information which just need to be harvested systematically. As Dan has already covered the valuation process for loans, I like to use a private equity example. The fair value of any private equity stake is determined by a process of triangulation, in which the fair value is a result of a calibration using the the valuation process net operating profit after taxes, or NOPAT in short, of the private equity holding. Secondly, the cost of capital to finance this cash flow. Thirdly, revenue multipliers of the comparable companies. And fourthly, the liquidity adjustment for holding not liquid assets. All of those input parameters into the fair value calculation are subject to both true uncertainty and measurable risk, to use here an old-fashioned distinction from Frank Knight. Uncertainty, or the truly unknowns, are located in the expectation of future cash flows, or more precisely in the expectation of the net operating profit after taxes. As we do not know how accurate those expectations are, the only method we have at hand is to perform some stress tests on those expectations. The other 3 pillars are directly observable. We see different ranges of cost of capital over time. We can observe different revenue multipliers from the comparable company analysis. And we got historical values for the liquidity adjustment. All those can be made subject to traditional mean variance analysis, known as value-at-risk calculation. But this time, the value-at-risk analysis needs to be conducted in a three-dimensional space, and this for different expectations or scenarios regarding the net operating profit after taxes. This sounds difficult, but it is essentially a simple view on 3 different distributions. One distribution for the probability ranges of the discounted cash flow outcomes, one distribution for the probability ranges of the comparable security outcomes, and one for the probability ranges of the liquidity adjustments. Those are also the 3 basic input blocks into the fair value calculation process, but this time seen as probability ranges. Of course, those 3 different probability distributions are not, and I repeat, are not independent from each other. They are correlated among each other, which makes the random drawings for a traditional Monte Carlo analysis not as straightforward as implemented in traditional value-at-risk opinions. So you simply need a set of correlated random numbers. One for the discounted cash flow outcome, one for the comparable security outcome, and one for the liquidity outcome. This can be done by using copulars as our random generating engine. So far to the technicalities. The outcome of such an analysis is again a simple probability density distribution which allows us to predict the reading of the value at risk at any desired confidence level. We can as well compute the potential tail loss, answering the question what would happen of those events left of the confidence level would occur. The complete description of the probability space allows us further to answer questions with regard to the shape of the distribution, its skewness and kurtosis. The value at risk in a private equity portfolio is simply not normal distributed, as seen easily in the graph in the middle right column. Those values, value at risk and tail loss, can be computed for different scenarios regarding the net operating profit after taxes. For our sample case, those values are computed in a table at the bottom right. Hereby, the base -10 or base -25 are stress tests, reducing the net operating profit by 10% or 25% respectively. So far to the risk measurement details. Much more could be said, but this webinar is not the place to go into all the details of risk measurement, but the basic principles should have become clear. Firstly, risk is the second dimension in the valuation process, or simply, without valuation, no reliable risk measurement. Secondly, risk measurement looks at the observable differences in the valuation input parameters. Thirdly, stressing those input parameters with the help of scenarios and by Monte Carlo analysis delivers a reliable framework. Finally, this framework has been developed to meet the strong risk measurement guidelines set by the Alternative Investment Management Directive. Thank you very much.
Thank you, Thomas. And here's the slide about Axiom Valuation Solutions Europe. Our next topic is Marketing Funds, Navigating the European Directives Regulatory Landscape, and will be presented by Mr. Angelo Lucara. Mr. Lucara is a partner with Deckert, LLP in Munich, and is an expert in all aspects of financial services law. He has significant experience. You can read more about his background on the Deckert LLP website. And now I would like to turn the presentation over to Mr. Lucara. Angelo?
Many thanks, John. Hello, everybody. I'd like to give you a brief overview of the new marketing restrictions that the AIFMD will actually introduce in Europe, and it will affect European as well as non-European asset managers, so U.S. asset managers and asset managers from outside of Europe. I would then also like to focus on, in my opinion, a major market in Europe with regard to marketing, which is Germany. So let's start with the AIFMD. What many of you may have read and may have heard about the AIFMD, and in particular if you are not in the EU, you may ask yourself, what is all of this about? And actually the principal aim of the AIFMD is to regulate any asset manager that markets to European investors, that manages a European fund, and that delegates either the portfolio management or the risk management to a European or a US sub-advisor or any other sub-advisor elsewhere in the world. Next slide, please. As you may know, the directive is actually not applicable in Europe as is, but as the name already says, it's a directive which provides some guidance, some binding guidance to the member states in the European Union, and which needs to be implemented by each individual member state into national law. And actually the final date that the AIFMD provides for its implementation in each individual member state is, as we heard already, July 22nd, 2030. There are a couple of member states that are actually implementing the directive at that date, and there are many countries that will not be implementing the AIFMD on time, such as, for instance, Italy, as I've heard recently, and some other countries. Germany will be implementing on time, and I will speak about that in a few minutes. So the implementation date is 22nd July 2013. That will be met by some of the countries, but not all of the countries. And we have a kind of transitional period that the directive provides for, and the national acts which implement the directive also provide for, of a year from July 2013 until July 2014. So you can say that within this year you have some grandfathering rights that apply, and you have some transitional and preliminary rules that apply. And in a nutshell, the managers have 12 months of time to fully comply with the directive, but at the latest on July 22nd, 2014, they must be ready and fully compliant. Next slide, please. So if you are a US manager or a manager outside of the European Union, or a manager actually managing an alternative investment fund, you may ask yourself, well, how will it be possible in the future to access the European capital market, and how could I place my funds? So as we've heard, there is some transitional relief that is helpful here. And maybe I should add, you may have heard or may have read in newsletters or in newspapers that it will be almost impossible to get European money into your funds, and that everything will be very restrictive and not worth probably thinking about entering the European market. It's not fully true. It's in most cases actually wrong, and there are a couple of ways. And again, back to my slide here, we have the transitional relief that applies. We have still the reverse solicitation possibility that still is possible. So whenever someone from the European Union would call you or would ask you to provide him with information with regard to your fund, or would ask to invest in your fund actually, you would still be allowed to accept any investments without any registration requirements, or without worrying about the application of the AIFMD actually. We still have private placement rules in place in some countries. In other countries, they have been abolished with the AIFMD, including Germany. Also, this will be a topic in a few minutes. We have the marketing of financial instruments which are outside the scope of the AIFMD, since the AIFMD only affects actually funds and not funding notes or any other type of financial instrument that might be similar to a fund but is actually not a fund and is therefore out of the scope. And then we have also the possibility to actually register the fund and to make use of the so-called passport, which in a nutshell means that if you are registered in a member state, and if you decide that this member state should be the responsible member state for you, if you are a non-EU manager, you may make use of a simplified procedure and register your fund actually for marketing throughout Europe, and not only, as is the case currently, in each individual country with with the implications that actually exist in each individual country. So that's a big relief in the future. All of these points, of course, are subject to local rules, unfortunately, so it's not all harmonized. So each individual member state may have some further restrictions as we see later. Next slide, please. Okay, so now let's focus on Germany. For maybe some of you that are attending an important market, actually definitely an important market within Europe and an important market for global asset managers. Next slide, please, John. And here the implementation of the directive actually brought a couple of significant changes with regard to the marketing. It introduced a new definition of marketing, and actually you can say that in the future, once the AIFMD will be implemented 22nd of July in Germany, any activity which aims at selling a fund, placing a fund in Germany, be the activity direct or indirect, will be considered to be a marketing of a fund, which will trigger a registration requirement before any marketing actually can happen. This is actually due to the fact that we have currently, under the existing act, which actually is only applicable for a month, we have the requirement that only a public marketing is triggering a registration requirement, whereby a non-public marketing is not. So the term public has been deleted from in the new rules, and so therefore any marketing will be considered to be a marketing of fund and triggers a registration requirement. There are a couple of limited exemptions that are not really helpful for actually non-German asset managers. So these are unfortunately not really helpful for any marketing activities. Next slide, please. So this means in the consequence that actually the private placement, as some of you may know, that is still possible in Germany, what would be the placement of a fund, let's say, outside of the applicable Investment Act rules. This possibility will go away, unfortunately. So you will not be able to test the appetite of German prospects with regard to your product. You cannot fly over to Germany and meet some prospects and discuss with them on a one-on-one basis and introduce your fund and then hopefully get them to invest in your fund. That will not be possible anymore. You will need to register your fund beforehand if you intend to market it proactively to German prospects. Again, as I said, if they would invite you to introduce and to present your fund, that would be considered to be a reverse solicitation, and that's still permissible. But let's be very clear here, reverse solicitation really means the situation where you do not solicit anything from the prospect that then would be calling you. So it must be a clear reverse solicitation without any activity on your behalf, which would lead to the prospect contacting you. Next slide, please. The new act will actually also introduce different classes of investors, which might be important when actually you consider the registration of your fund. We will have three different classes of investors. The first one will be the professional investors, which would mainly be the banks, securities firm, management companies, insurance companies. These would be considered to be highly qualified investors, sophisticated investors, and the registration for marketing to these investors is of course less burdensome and quite actually straightforward, I would say, depending on where the fund is located and where the manager is located. Then it would be for retail investors, which is in the next class of investors. Well, these are actually retail investors, as you know them already, all investors that do not qualify as professional investors or the so-called semi-professional investors, which on the next slide are defined. Next slide, please, John. These semi-professional investors, they are defined as, actually they are, again, in a nutshell, in order not to make it too technical here, the semi-professional investors have actually been created by the German legislator in order to catch all of those investors that in reality are sophisticated institutional investors, but do not meet the criteria in order to be treated as professional investors. So this is a quite large group in Germany, and they are currently all mainly invested in alternative investment funds today. And if the German legislator didn't create this investment in a class of investor, we would have a lot of, or let's say a major portion of the institutional German investors would not be allowed to invest into AIFs anymore, which wouldn't make sense at all, and therefore the German legislator created this investor class here, which exists only in Germany as far as I know. So these are, as I said, investors who do not meet the criteria of professional investors, but who can meet the criteria by complying with certain requirements here. As you can see, they need to be able to invest at least 200,000 euros. They need to have specific skills with regard to the risks and the specific investment fund strategies. And then this has been newly introduced, the second bullet point. Anyone who actually is willing and able to invest at least 10 million euros is automatically deemed to be a semi-professional investor. Next slide, please. Maybe to summarize again the transition rules, and that's also the end of my presentation. Again, hopefully in a non-technical words, we have a transition period in Germany from the 22nd of July 2013 until the 21st of July 2014 for non-registered funds. That means that any fund which is currently, as of today, or at the latest actually on 21st of July, privately placed in Germany can make use of this grandfathering period of a year and can then still continue, again within a private placement, to solicit new clients and new investors for the fund. If these fund managers intend to market and or to get new investors after the 21st July 2014, they must mandatorily register their fund, or they need to stop marketing their fund. These are the two alternatives. And to be clear, if you are not yet privately placed in Germany after the 22nd of July 2013, the possibility to gain any new investor in Germany within a private placement is gone away. It's not possible anymore. So you need to be privately placed before that date. After that date, it's not possible to perform any private placement in Germany anymore. That's all from my side.
Thank you, Angelo. In conclusion, I would like to summarize the key points from each of the topics in the webinar. First, Stan talked to us about valuation. And the first key point is AIFMD imposes separation, and that's independence between investment manager and post-investment valuation of assets, and must be vetted by an independent or a third party. And his second major point is IFRS 13, the fair value standard, is the only standard that meets the objectives of AIFMD. And then Thomas talked about risk, and there are two key points that I pulled from the risk presentation. And the first being that risk is the second dimension of the valuation process. The two are linked. And secondly, stressing input parameters with the help of scenarios and by Monte Carlo analysis delivers a reliable framework which does meet the AIFMD guidelines. And then Angelo talked to us about marketing, and the first point being AIFMD affects any asset manager that markets to European investors, manages a European fund, or delegates to a European or U.S. sub-advisor. And secondly, no private placement regime under the new law Registration is required for any marketing, and reverse solicitation is still possible. And finally, there's a transition period of 1 year starting the 22nd of July, 2013. So those are the key points. Now what we'd like to do is open the presentation to questions. If you have a question, please type it into the questions box on the menu on the right-hand side of your screen. We'll get to as many questions as time allows, and then answer the remainder on an individual basis by email after the webinar. So please type your question into the question box, and we'll get to as many of those questions as we can. So the first question I have that is shown up here is, I think this is probably a question for Stan. And the question is, I'm not sure what is meant by positive assurance. So Stan, could you take that for us?
Sure. Thank you, John. It's a simple concept. Positive assurance really means that prices are established by investment managers, and that those prices need to simply be vetted to be shown to be within the fair value range. So the directive really doesn't indicate that that the valuation function should be given up to an independent third party, but basically what it says is whatever the prices of the assets are at the measurement date, that they are within the fair value range, and there an objective third party needs to determine or conclude that that is in fact the case.
Thank you, Stan. The next question, I think this is probably for Thomas. The question is, are you offering risk software for the risk in private equity space?
No. Sorry if this risk measurement section has caused this confusion. We are not, or Axiom Valuation is not offering software according to my understanding. The offering is clearly a service that is adjunct to the valuation process. So the understanding is that the valuation process comes first, and out of the valuation process, you are looking at probability ranges of your parameters, and those probability ranges of your parameters are delivering you the value at risk or the expected tails, whatever a customer would like to look at. Thank you, John.
Thank you, Thomas. Next question here, probably Stan again. Can my audit firm provide valuation services? Stan?
Thank you, John. If the firm that's auditing the fund cannot provide valuation services or even risk management services in this case, it would essentially be a conflict. You can't audit what you valued, or you can't audit the analysis that you've done for risk management purposes. What you could do is you could hire if it's a third party, you could hire another audit firm that you thought had met the valuation requirements or could do the valuation risk management work, but that audit firm wouldn't be the audit firm that's auditing your financials. So in short, the answer is there's a conflict. The conflict really does require that that the conflict's removed if a third party is involved in the valuation and risk management analysis, and that third party is not your audit firm.
Okay, thank you, Stan. So now we have a question. I think this would constitute marketing of a unit or share in that fund.
Does the marketing of debt? Sorry, what's the question?
Yes, let me repeat that question. Does the marketing of debt of a fund constitute marketing of a unit or share in the fund? Yeah.
Well, it depends on how this marketing of debt would be structured. Whether at the end you would need to look whether the this debt, however it will be structured, is an alternative investment fund or not. It's there is no general answer to that question, unfortunately. You would need to you need to assess actually each financial instrument which you would like to market into Europe, and then decide whether this is an AIF, an alternative investment fund, or whether it's not an AIF. There are some specific requirements to assess whether it's an AIF or not, and therefore it depends and needs to be assessed on a case-by-case basis.
Okay, and then Stan, do you have something to add to that?
Yeah, I think just to follow up on Angelo's comment, if it's I think the question, the person asking the question, I think they meant that the whether an alternative investment fund or any fund for that matter actually issues debt to a third party, which might be another alternative fund. Would that fund constitute a unit or share in the fund for marketing purposes? And again, Angelo is the expert in this, but I think the marketing of a security by a fund or anybody else to another alternative investment fund in Europe would be subject to the directive. And maybe I have that wrong. I'm not an expert in this, but given the guidelines, I would think that would be the case. Angelo?
Yes, probably. But as I said, yeah. I mean, if it's simply a security and not a unit in an AIF, you would it would not fall under the AIFMD. But potentially, if it is something that is issued by a fund, you would rather say, well, it is a unit, and yes, it is covered by the AIFMD. But it's really difficult to make a clear, unfortunately difficult to make a clear statement here, because it really depends on how the instrument is structured. And you know, a small detail maybe that is changed will lead to completely different results.
Okay, thank you, Angelo. So we have time for just one more question. The question is, are risk management and valuation two separate things? Maybe Stan, do you want to address that?
Well, I think, as Thomas indicated, the valuation and risk management are part and parcel of the same process. You can't do risk management without valuation. The basic structure of a risk management program is essentially predicated on stressing the various inputs that are used to the valuation, and that's the purpose of the risk management analysis. And in the more aggregate, in the aggregate, if you will, which is really what the directive is after, I think, is the systemic risk of the system. Clearly, you'd have to stress test these parameters across managers and across funds to get some idea of what what the systemic risk within the financial system at any point in time happens to be. So the answer is they are not independent. That one depends on the other, namely that risk management depends on valuation and the identification of the variables, the inputs that drive the valuation. And that's where the standards are very, very useful, because the fair value standard actually identifies, in general, what the market parameters that need to be used. It's reasonably specific. It doesn't say use a credit curve here and don't use it there, but basically says use inputs that a market participant would use to value whatever security that's being targeted. And of course, given the information that's available to professional investment managers, whether it be Bloomberg, Reuters, or any other service, it's pretty clear that market participants have a whole slew of information about market settings and can use that information to value the various securities. So I think in general that not in general, but specific, valuation and risk management are not independent activities.
Thank you, Stan. So I'd like to thank all the presenters. I'd like to thank all the attendees. We will send out to the attendees answers to any questions that we didn't get to and ran out of time here. And we will also send out the slides and copies of the webinar. So thank you very much for attending the webinar, and have a good day.